Are you paying for your car insurance monthly? You are funding a high-interest credit scheme. We expose the hidden interest costs, the astronomical annual percentage rates APR, and the financial entities profiting from this predatory practice, showing you exactly how much this monthly payment cost your household last year. When a UK driver opts to spread the cost of their essential car insurance premium, a non-negotiable expense mandated by law that covers personal liability and significant vehicle risk over 12 installments, the industry carefully frames it as a benevolent, flexible, and responsible budgeting solution. This narrative aggressively markets the convenience of managing a substantial annual cost that can run into hundreds or even thousands of pounds, effectively easing the immediate fiscal pressure on household budgets. Crucially, however, this supposed act of convenience is emphatically not a complimentary administrative service or a minor processing charge. It is fundamentally a premium finance credit agreement, a legal instrument that functions identically to a high-interest, short-term loan that often carries an interest rate 2 to 3 times greater than standard, transparent personal lending products available on the high street. The premium finance trap, entering the shadow banking system, the true nature of the transaction, an instant debt the very second a consumer clicks or ticks the pay monthly option on an insurer's digital or physical application form. They are instantaneously bound by a dedicated legally separate financial contract known as the credit agreement, distinct from the core insurance policy itself. The entire mechanical process is cunningly engineered to maximize the insurer's financial leverage. The insurance company first immediately remits the full annual premium to themselves or the underwriting entity upfront, thereby securing the entirety of your 12 months of indemnity coverage and transferring the full risk liability. They then, in essence, function as an unsecured lender, lending that entire principal premium sum back to you, the consumer, who becomes contractually obligated to repay them or their designated, and often highly obscured, third-party finance vehicle the principal amount plus a punishing interest rate over the subsequent 12-month period, which usually begins with a higher initial deposit payment followed by 11 smaller, precisely equal installments. The identity of the shadow lender and regulatory evasion. The identity of the party providing this high-rate credit is often deliberately and confusingly kept ambiguous in the documentation. It might materialize as a sister company, a wholly owned financial subsidiary of the main insurer, often referred to internally as a captive finance firm or a dedicated external finance house, that professionally manages the vast portfolio of high-interest premium loans on the insurer's behalf. In every single instance, the ultimate objective of this complex arrangement is not to merely recoup administrative costs, but to generate substantial guaranteed and low-risk additional revenue for the entire financial group from the persistent stream of interest, thereby creating an extremely profitable side business that operates with minimal overhead and, crucially, almost zero credit risk exposure to the lender. This structurally sophisticated financial arrangement is painstakingly crafted to allow insurers to operate under a specific less regulated regime governing ancillary credit or premium finance, enabling them to circumvent the stringent disclosure and transparency requirements of the Consumer Credit Act that standard personal loan providers must adhere to. This critical regulatory blind spot is precisely the mechanism through which they manage to quote and subsequently implement the jaw-droppingly high interest rates that are routinely applied to these monthly agreements, rates that would trigger immediate regulatory investigation and heavy scrutiny if offered by a regulated high street bank for any comparable consumer loan product. Exposing the poverty premium, a systemic abuse. The unethical tax on financial vulnerability. Prominent consumer rights advocacy groups, including Citizens Advice and influential financial watchdogs like the Financial Conduct Authority (FCA), have universally and unequivocally condemned this sustained systemic practice, rightly giving it the damning and ethically charged name, the poverty premium. This acts as a non-negotiable, punitive financial levy imposed disproportionately against financially vulnerable drivers, those who are genuinely unable to immediately afford the full lump sum, punishing them with punitive finance charges purely for the necessity of needing flexible monthly budgeting. This unequivocally represents a significant ethical failure at the highest levels of the insurance industry, as it fundamentally penalizes customers based on their liquidity and financial position rather than a true assessment of their driving or underwriting risk. The hidden APR and the flat rate interest deception, the annual percentage rates APR applied to monthly car insurance payments, are a clear indicator of systemic market abuse that exploits a regulatory loophole for profit. To provide critical context, While a typical fully regulated secured personal loan might sit comfortably in the single-digit range of 5% to 8% APR, and even an expensive store card might peak around 25% or 30%, insurer finance plans frequently reside in the egregious range of 20% up to over 35% APR. These rates are often comparable to high-interest payday loans or unsecured revolving credit, but are applied to an essential, non-discretionary service and lack many of the standard consumer safeguards. Industry investigations have extensively documented extreme, outlier scenarios where the rates, when correctly calculated using the standardized methodology, have been confirmed to reach an astonishing 45% APR or even higher. Furthermore, many of these premium finance agreements employ a highly detrimental flat-rate interest calculation, which is profoundly worse for the borrower than the more common reducing balance interest calculation. This deceptive flat-rate model forces the customer to continue paying interest on the full original loan amount for the entire 12-month period, even as the principal balance steadily decreases with each monthly repayment, exponentially compounding the total financial damage absorbed by the consumer. The FCA's stance and price governance. These exorbitant figures are deliberately rendered opaque and difficult for the average customer to locate. They are commonly buried deep within the complex jargon of the policy documentation's small print disclosed only in the final stages of the terms and conditions document, and are rarely highlighted clearly alongside the initial premium quote, making them extremely easy for the consumer to overlook entirely in their rush to secure essential coverage. The Financial Conduct Authority (FCA) has recently turned its attention to insurance governance, particularly regarding the concept of price walking and poor value products, but the premium finance APR remains an area where mandatory front-page disclosure is urgently needed to restore transparency and fair competition to the process. The whistleblower test. Find your hidden costs, the financial damage, calculating your annual loss. The most immediate, unambiguous, and effective way to quantify the hidden financial damage imposed by this system is to run the calculation yourself. Take the single-figure annual premium quote and compare it against the final, cumulative amount you actually pay when all 12 monthly installments are painstakingly totaled up. That resultant difference, that alarming delta between the two figures, represents the pure, unadulterated, lost interest and administrative fees that have been transferred directly from your personal bank account to the finance company's balance sheet. High-risk drivers. Amplifying inequality, the financial devastation caused by this practice is not evenly distributed. It is exponentially worse for high-risk demographics, such as young drivers, new drivers with limited history, or those residing in dense urban areas where the base premium is already severely inflated. The opportunity cost, wealth erosion. Beyond the direct, punitive loss of cash, one must consider the substantial opportunity cost of this unnecessary expense. That lost sum of £212.50 or £450 saved could have been used to fully fund your vehicle's annual MO and a comprehensive yearly service, covered the critical cost of new premium tires, contributed significantly to an accessible emergency fund, or been strategically funneled directly into a high-interest ISA savings account where it would compound into substantially greater returns over time. Instead, every penny was handed over to a finance company to pad their quarterly profits, representing a significant deadweight loss to your personal wealth portfolio. The dual consequence, credit score damage, and the CPA trap, the immediate threat of the hard credit search beyond the excessive and punitive financial cost. Utilizing the insurer's monthly payment plan introduces a severe and often overlooked threat to your long-term financial health, the potential for devastating damage to your credit score. The mandatory application process for the monthly plan always triggers a hard credit search on your file. This activity leaves a visible footprint that actively signals to all future lenders for the next 12 months that you have sought credit. While a single isolated search is often negligible, an excessive number of these hard searches within a short period, especially when switching providers annually, will cumulatively and negatively impact your overall credit score and reduce the number of competitive interest rate offers you receive for major loans. Continuous Payment Authority (CPA) and spiraling debt insurer payment plans routinely depend on securing a Continuous Payment Authority (CPA) mandate. This is a contractual agreement that empowers the insurer or the finance company to execute payments directly from your nominated debit or credit card without needing explicit reauthorization for each monthly installment. If an installment fails due to insufficient funds in your account, the CPA allows the provider to repeatedly and relentlessly attempt to draw the money from your account, often triggering multiple failed payment fees from your bank, in addition to the late payment fees and interest penalties charged by the insurer. This insidious mechanism rapidly transforms a minor, temporary financial shortfall into a severe, spiraling debt issue and an immediate, costly policy cancellation. The ESCAPE Plan, Zero Interest Alternatives, and the Premium Fund, the strategic 0% purchase credit card solution. The empowering news is that you absolutely do not have to passively acquiesce to this hidden premium tax. The most powerful, elegant, and readily available solution for the majority of UK drivers with good credit is the strategic and financially responsible use of a 0% purchase credit card. Many major UK banks and established financial institutions currently offer credit cards featuring generous introductory 0% APR periods that can often last between 12 and 24 months for new purchases, specifically designed to entice and reward new, credit-worthy customers. The strategy is simple and immediately reverses the power dynamic. Use the 0% card to pay the full £850 annual premium to the insurer upfront. This single action immediately and permanently cuts out the insurer's punitive 25% plus finance charge, ensuring the high-interest insurance credit agreement is never established. You then simply manage and pay off the credit card balance monthly, entirely interest-free, managing the repayment on your own terms over the entire promotional period. Critical warning and management protocol: you must maintain rigorous financial discipline and commit to clearing the entire balance before the 0% promotional period expires. The Premium Fund Strategy: becoming your own lender, the ultimate long-term financial strategy, is to execute what we call the Premium Fund Strategy. Open a separate, high-interest savings account, such as an ISA or Easy Access savings account designated exclusively as a premium fund, immediately upon purchasing your annual policy. Calculate the new monthly cost and deposit this exact amount into the fund every month for the next 11 months. This way, when your policy renewal is due the following year, you will possess the full lump sum ready to pay annually, and critically, you will have earned interest on your money throughout the year rather than having paid it away to the finance company. This strategy entirely reverses the financial dynamic in your favor, turning an expense into a small, steady source of income. Take immediate, decisive control of your premium financing. When shopping for your next policy, always demand the annual lump sum quote first, then explicitly challenge the agent or meticulously check the documentation for the exact annual percentage rate APR on the monthly plan. If the quoted APR is over 10%, which should be the absolute maximum benchmark for a fair rate, you should immediately reject the insurer's finance scheme and actively explore one of the low-interest or zero-interest alternatives detailed here.